because most of the government policies, many consumption patterns, and even the broader macroeconomic things like interest rate and everything, you can judge from the demographics of a particular company. So, in this presentation, we will try to explain to you how you can use demographics to identify very long term and strong trends emerging in an industry, in an economy, and use it to zero down on an economy or on an industry as to what you should look at and how you can decipher that what is the industry or what is the country that you can look at depending on the broader demographics, because we keep hearing a lot about demographic dividend. So we'll try to understand that how to ascertain what kind of demography we are sitting on and how the flow of funds will happen globally. That will also aid your decision and the amount of bullishness or bearishness you can have in the long term for a particular country. So basically, what are demographics? So as you can see in the adjacent chart, there are small cyclical trends which happen over a 6 to 18 month kind of horizon, and the larger secular trends happens over the 3 to 5 plus kind of years horizon, which is usually the industrial cycle we talk about. So demographic analysis is the study of population based on factors such as age, race, and sex. Demographic data refers to socio-economic information expressed statistically, including employment, education, income, marriage rates, birth and death rates, and more. Government corporations and non-government organizations use demographics to learn more about a population's characteristics for many purposes, policy development and economic market research. So basically, what it means to say is that any government policy or etc. is based on these broader understanding of the way the population is placed. So your more productive age is the 25 to 64 kind of band, where you are more productive, and this changes over a period of time because life expectancy keeps growing up. Like in the past, like till now, we had an age expectancy of anywhere around 70 to 75 years. Now in the developed world, it is going up to 85, 86 years average age expectancy over the next 10, 20 years. And in our case, or in the developing world, the expectancy is that your average age should be somewhere around 75 to 80 years. So as the your average age increases, your retirement planning, everything has to go up. So the people who are a burden on the government's exchequer, if that ratio keeps going up, that substantially impacts the long term secular trends. Japan is a classic example where the peaking of the 25 to 64 year age group happened somewhere between 1990 to 2000, and we have already seen how the economy is placed. So that is one important aspect that you need to understand to decide whether you want to go into a country as an investor or not. So demographics is destiny. While many other things which are economic in nature, as we have been seeing in the recent past, that a lot of money printing can do a lot of good to various economic numbers and everything. But demographics is something you cannot change. Japan is a classic example. Last 20 to 25 years, they have putting in a lot of money. Recently, they have been buying equity as well, but still, it is very hard to reverse the trend. We'll discuss later on that how their population demographics is going to change even in the next 10, 15 years, and how that will impact them. So demographics is something you cannot change, and the age group of 25 to 64, their productivity, their ability to produce more, consume more, really adds up significantly to the long term trends, and they only decide what kind of products and usage will be required. So you can use this for long-term economic analysis, redirecting an uncertain future. So many times in the short term, there are so many moving pieces. We develop a lot of uncertainty regarding how the economy will pan out, what will happen, what will not happen. But this broader understanding of demographics will substantially ease that undue pressure, and you will get a lot of clear clarity on the long-term trajectory of the country's economic situation and which industries or which companies can benefit out of it. So economic growth is population plus productivity, and it can also be how many people work plus how productive these people are. So, like this is a classic case of America where we all know that fertility rates have been falling. people are not having as many children as they used to have. The 2.1 kind of ratio that we need to replace current population is not happening in most of the developed world. America is not different from that. So you can look at the population change that is happening. Gradually they are getting into a zone where it is in a deceleration mode. And later we will discuss how the share of the aged or the dependent people is actually increasing at a very rapid pace. And the age group of 25 to 64, which is the more consumption oriented age group, or the productivity oriented age group, that is gradually coming down. So that is why America has this problem. So inflation is a problem that they have, because the number of taxpayers keeps coming down, while the people who are dependent on that tax income is going up. So that creates a lot of burden on the exchequer. So how if this is a chart which shows that how population growth and labor force, which is 25 plus, both are correlated. So as you see, the population growth in the 25 to 64 band keeps coming down and is expected to further decelerate over the next 7 8 years. Your labor force participation will also come down, and hence the productivity will come down. The adjacent chart also shows you a comparison of the long-term dependence of GDP growth with this labor force growth. So as you see, the labor force growth keeps coming down. Your nominal GDP growth rates have also collapsed from somewhere around 3% to somewhere around 0.5%. So both are moving in sync. So for any country where you see labor force or the 25 to 64 band basically gradually coming down, you can more or less expect that in the long term, your nominal GDP of that country will also continue to come down. So that is one reason you can be hopeful that more or less long term flows out of that country will happen. Some delays can happen, because obviously these are very long term trends, 3 to 5 years kind of, and they take a bit of time to show up in your numbers. So by the time people really accept that maybe US is getting into a Japan kind of problem, uh, whether artificial intelligence or any kind of robotics can solve that to some extent with manufacturing 2.0 or something like that, that is a different deal. But otherwise it is very difficult, as we see that even from 1980 till now, both are moving in sync. So gradually you can conclude that something that has been moving in sync for around 40 years, there is a very low key probability that some huge technical or technological innovation will come in and change the trend. So US could have these problems in the long term as well. So this is again labor force growth and CPI inflation. So as we were talking earlier, that demographics connects you to the labor force connects you to inflation, interest rate, and GDP. So everything is getting impacted in consonance with each other, because obviously all these broader economic factors are connected. So you can clearly see that as the labor force keeps coming down, your inflation levels have also been coming down. In Japan, we have seen this possibility that over the last 15 20 years we have seen no inflation basically. And obviously then connected interest rates have also been much lower, in spite of the bank, so the country trying to put in more money into the hands of the investors and the country as a whole. So again, how higher interest rates could push Washington towards a federal debt crisis. Now, again, obviously, Fed fund rates and all this lower force, this puts more pressure on the balance sheet. Once this pressure, as we all know, that liquidity is a problem for them, there is a lot of debt on their balance sheets. So once interest rates start moving up, they will have a lot of crisis in terms of the ability to repay these debts and everything. Right now, it is a fiat currency, so you don't have much talk about these debt crisis. But over the long term, you can be rest assured that if this continues as it is, then obviously there will be some issues that the US will face because of this falling labor force. And this is labor force growth versus your 20-year treasury rate. So as we spoke earlier, that even interest rate is being affected because of the labor force participation going down. So see, you can see that from 1985 it started peaking, and from there on it's been coming down in consonance with the labor force participation. And similarly, if you look at the average consumption by age group, you see that the high consumption is done by the 35 to 44 band. And as you age beyond to a particular level, your propensity to consume is gradually coming down substantially from around $74,000 to around $40,000. So this is the type of impact. This is certainly, and within this there is a difference that what kind of consumption we are doing. So a person aged 65 to 75 will have a different consumption priority vis-a-vis a person aged in the 25 to 45. So like 25 to 45, you are expected to consume more on the real estate side of it. You might be buying a new vehicle, but as you age, your the investment patterns as well as your consumption patterns change. So someone in the earlier age cohort will obviously go out and put more into equities and take it more into riskier assets, while someone on the higher age pattern will try to have more secure kind of investments in the books. So that is an investment pattern difference also that comes into. So gradually equity participation should also come down, and obviously your real estate and automobile sales should also get affected because of this age pattern shifting into the higher bracket. So this is again labor force growth and nominal GDP. As you see, both are again moving very much in consonance, and this is something that has happened for the last 15, 20, 30, 40 years. So there is no reason to doubt that this problem is going to happen in the US. We for India are in a sweet spot, so we should not have much of these kind of problems at least till 2080, 2100 kind of situation. So we should be in a very sweet spot with regard to this labor force participation issue actually. So this is how your 25 to 64-year-old relative population on this side, or right hand side of the chart, and on the left side you can have a look at the GDP, that how it has moved during that period. So you can clearly see that as we age out into a particular band, and as we peak out in terms of your 25 to 64-year population, gradually your GDP numbers are collapsing to a lower level. Also, your GDP growth is also impacted because of this. So gradually, this is expected to further decelerate over 2030 to around of 49%. So that should be the problem area for US. Average consumption, housing plus vehicles. So again, you can see that the average consumption that the 35 to 44 band, 54 band is usually having a lot of expenditure into housing and vehicles. Gradually, as you age out, your consumption of those goods comes down. And broadly, if you want to understand any economic into its prime, you can see that housing and vehicles will obviously go up. So gradually, what you should expect in a maturing economy where your age group gradually shifts to a higher band, your housing and vehicle sales should gradually flatten out, peter out, and should be much lower because the dependent economy is larger, and they do not have a demand for new houses. So that is something you have to understand. In India, particularly, what will happen? This housing and vehicle sales should go through the roof over the next, say, 2 3 4 decades gradually, because our this income group of 35 to 54 will continue to expand for the next, say, 70, 80, 90 years. Now, how we channelize this demographics is another challenge for any government that comes into power. But broadly, if we don't consider too much of an impact of any government, then gradually that should keep growing up at a very healthy rate. So housing and vehicle should be the cornerstone for the growth in India. This is the relationship between age group size and real GDP growth, real growth in GDP per capita. So as you can see, as we age beyond 45 to 49, gradually your GDP per capita is actually coming down. So your most productive age remains where you can peak out is around 15 to 19 to 45 to 50. So beyond that, most of the consumption is very low key, and it does not really propel your GDP growth into a different level. Your productivity also continues to drop. So it should be a high focus area. So too young a population is also a drag, while too old a population is also a drag. So this peak age between 20 to say 45, 49 is the best age group to have for an economy actually, because you have a larger number of taxpayers and you have low dependence, and these people are productive, so your GDP increment is very strong because of this these presence. So yes, US, while in the earlier numbers looks very bad, but if you look at the annual growth in number vis-a-vis China or a Europe, you will see that US continues to play to above the negative zone continuously for another 7 8 years, so they might manage it better than China and Europe. While China will have a very drastic fall, you can already see that they are talking about giving up their one child policy and all that, because they can also see that 2050 55 and over the period of next 15 20 years they might be in a very problematic zone where the dependency would be much higher. Japan, as you can see, since 95 2000 has been into that zone and has never been able to come out of that, barring that small pickup from 2015 to 2020 22. But again, that's not material. You continue to be in the negative side only. US will somehow manage to get through that. And on this side, we have the India projections till 2100. You can clearly see that till 2060 70, we are nowhere near peaking in terms of the 25 to 64 age cohort. So I think you can be very rest assured that till 2060, the long term trajectory 2060 70 should be very strong for India. And how we channelize this demographic dividend is very important. But in terms of the demographic dividend, it is certainly there for India over the next, say, at least 40 50 years easily. So now, when most of the dependency ratio, so dependency ratio is what? The dependency ratio is a measure of the number of dependents aged 0 to 14 and over the age of 65 compared with the total population aged 15 to 64. So the productive age, productive population vis-a-vis the dependent population, that's it. So as you can see, the China bar has already shifted somewhere around 2010, and we all know that getting that growth on for China has been a very big challenge, and it is expected to subsequently go even lower. So your ratio of working to non-working is going to be a problem for China in the future as well. While for India there is still so much time, because 2010 onwards China did not see. China mostly saw their problems resurfacing, I believe, just prior to COVID around 2017 18, where growth started to slacken. So I think India is still in a sweet spot over the next, say, 40 50 years, and after that maybe we see some ramifications of this problem and everything, how India shapes up. But broadly, you can be rest assured that India is going to be in a sweet spot over the next 30 40 years. And since it is going to be better than China, you can expect most of the flows to be also favorable for India. So FII flows, while they have been a problem in the recent past, gradually as these demographic things come in and the long term investor stays in, and more funds flow comes into India, gradually that should happen. That should help India in a big way. So this is how the age dependency ratio is going to affect in the US. So you can very clearly see that the dependence is continuously increasing from 49.5 to around 53.9, and it is expected to go up to 60.6. Similarly, in Europe, there is a similar situation. The age dependency is going to go up substantially, and this is going to impact economic growth. And we all know in the developed nations, consumption is a major part of the total economic pie. So, if this is going to be the change, there is a lot of sectoral shift that will happen within the consumption patterns, and that will substantially dampen the GDP growth numbers for these developed countries as well. And debt, as we all know, there has been a lot of talk that how the total public and private debt to GDP globally is going up, and we can clearly see that it is very high. It is primarily because of the developed nations. So, in a case where the population, productive population within the age group of 25 to 64 is much lesser, for countries to service this debt is going to be a very big problem. And obviously it will have an impact on your real GDP per capita as well going forward, because the productive labor force is going to shrink. Basically, as I was telling you, Japan's population is expected to decline by 40% between 2020 to 2100, falling from 126 million to 75 million. Now, this is a very big problem for most of these countries, and they will have to dole out some policy initiatives to get into this. Similarly, if you look at the population trends and everything, if you have an aging population like the case is in US, then obviously your requirements for various pharma related things will obviously go much higher. And in India, what is happening is, if you look at the broader trend within the new generation, is that they are not so obsessed, like the newer generation is not so obsessed as the earlier generation with owning of assets. They are happy with a rented property. They are happy with Ola or Uber being used rather than owning a car. In some cases, they are even happy owning rented furniture. So I think that is the change that you have to assess in a different economy at a different point in time. Like I was reading somewhere that this thing, the pet demand has gone up through the roof because of COVID. Even normally, it was expected to grow at a very rapid pace, but so pet care and everything industry related to that can go through the roof. Harley Davidson was a classic example. When they came into Russia, they wanted to sell those bikes. Those They are heavy guzzlers and very heavy bikes. So somehow Asia did not accept them. So they never connected to that change in trend basically. So demographics, if you study properly, you can get an understanding of the change in trend, that whether the consumer is savvy, very centric on cost. Like India is a cost centric economy. So here, if your cost is going through the roof and your product maybe a better quality product or has some esteem in terms of its brand and everything, but still it will not work. So different economies have different logic. So in India, largely the trend that we can expect is that housing, auto, these things demand should go up. The newer generation does not believe in owning so much, but then the rental demand should keep going up. So an Uber or Ola isn't listed, but then an M&M is listed, where you have the Meru cabs play within it. Similarly, in the housing space, there are a lot of residential housing companies that should keep doing very well. So I think that's it. If you want to understand about long-term trend in a particular country, understanding demographics is very essential, because it will, in the long term, drive your growth in terms of the interest rates, in terms of the GDP growth rates, as well as your various other macroeconomic factors, inflation, etc. So I think the whole thing summary of this project is that India largely is in a very sweet spot over the next 50, 60 years, and growth should be very robust, and further complemented by degrowth in some of the major competitors, something like a China or some of the developed nations like the US and Europe. So a lot of fund flow in the long term should happen. So while short term fund flows may be jittery because of the fast moving money, but long term money, you can be rest assured, is going to come to India, because when someone compares it at the global scale, they will consider how demographics play out, and that will have a very important role to play in how we decide on an investment destination in a different country. I believe that's it. If you have any questions, I'm open to answering them. Ah, yeah. So we have a question that view on Tata Power and Tata Motors, DVR, and Tata Steel. Uh, Mr. Gupta, basically Tata Motors, Tata Motors specifically, I'm very positive. And I think Tata Motors is going to be a very strong story going ahead. In terms of earnings growth, it is going to be very good. And gradually, if you look at the current quarterly numbers, the JLR numbers have been very good. Primarily, the problem is on the supply side because of chips, but that has also gradually been addressed. And I think next quarter onwards, you will see very good growth. The new products on the JLR side are being received very well. If you look at the new order book, there is a lot of demand from the new products as well, which should be higher, and which should get higher margins for the company. Add to that the domestic scenario. I think after the GST issue, I think the oversupply that was created because of smoother transit of transportation, that resulted in a lot some oversupply in the logistic space. I think over the last 2 3 years that has been more than absorbed, and now we are in a very good spot there also. And gradually, your logistics as well as everything, if you look at it, the demand up move is expected to be very strong. That should help the CV segment. The passenger car segment, for a change and after a long time, for Tata Motors has come back into place. So that is again very positive. So I think Tata Motors is a very good bet, and we are very bullish on the stock. And I think every quarter on quarter you will see substantial improvement in the number, both led by the international operations as well as the domestic operations. Um, and I don't think that raw material prices anymore are such big an issue, and gradually that should also come down. So I think overall margin improvement because of raw material prices coming down, product improvement, better utilizations. I think it's a very decent bet to have in your portfolio at this point in time. And obviously, debt repayment should also happen over the next 1.5 years. I don't see any kind of hiccups coming up, barring that since it's a global company, multiple operations, some currency headwinds here and there in a quarter can affect it. But beyond that, I think long term, I'm very bullish. We are very bullish on Tata Motors. So Tata Motors or Tata Motor DVR, either way, it's a very decent bet. Uh, Tata Power, I'm a bit skeptical about the valuations at the current levels. I think most of the renewable energy valuation that has to be built in is already built in. And the cost we would incur in putting up the charging infrastructure and the revenue model that would come out of the charging infrastructure, I'm not very sure how lucrative that is going to be. And I think most of it is already valued in the price. So, Tata Power, I would give a pass at these valuations. Tata Steel, I think we have a neutral view on the stock because of the overdone correction right now. If you look at HRC prices, you might feel that they've corrected a lot from the top and there is little scope. But we need to understand that this is the top end of the band within which the HRC prices used to trade prior to COVID. So this is still the upper end of the band. So if normally they have to trade, they should be at least around maybe 200 $300 lower from the current prices as well. So some correction there can happen. But if you talk in terms of valuation, I think again, steel metal as valuation, they don't look very expensive. Momentum wise, if you look at the dollar index, I think more or less it has topped out. We would await another 4 or 5 correction, 4 or 5% correction on the dollar index to confirm that it is really giving some leeway to a further correction. But gradually, we think normally we think that dollar has more or less topped out, as most of the other countries have started raising rates, and that should impact dollar prices and the dollar index particularly. So gradually, that should top out, and that should help metal stocks. But in terms of the runaway rally and the perception that was earlier that we are into a super bull cycle in commodities, I think that's a bit overdone. So Tata Steel, Vedanta, these could be very stable kind of players. Leverage has come down, but again, if they have to put up new capacities with greener capacities to come on place, they will again have to put new funds into those new production units. And obviously the return should be much subtler into those units because you have to comply to the green manufacturing norms. So I think Tata Steel, I would be largely neutral at this level. And within metals, if I have to bet on something, though leverage has not come down, but Hindalco has some levers. So I think Hindalco could be a better bet compared to Tata Steel in the long term because of the shift into aluminum and EVs and all that. That plays very well for them. Yeah, see, population increase does lead to inflation, but you also have to understand that right now the problem we face is whether it's deflation or not. So, inflation per se is not bad. Beyond a particular point, inflation creates problems, but within a particular level, inflation is actually good for any country or any economy. So in the short term, while inflationary pressures are considered very bad, but if they stay within a particular band, it is not as bad. While deflation is particularly bad. With demographics, what happens is you go into a permanent cycle of deflation that substantially erodes the ability of an economy to grow and bounce back. And once you are not growing, you don't have any kind of, like I gave you the example of China, where 50 million people are not going to be present. So if as a country you are losing 50% of your population, it is a huge problem. We consider in India, being in India, we consider population as a problem because we have been overpopulated for so many years. But in the developed world, if you look at Spain, Germany, everywhere, they are working on immigration laws to get more people into the system, because to replace the existing population and the working force, you need 2.1 kind of growth, whereas most people are not having that many kids or not entering into families. So that results in a lot of productivity loss. And gradually, what happens in a developed economy, there is more dependence because most of the senior citizens are guaranteed certain benefits, whether medical or etc., by the government. So if you consider that the 65 to 25% of the population is producing the maximum amount of goods and everything, and 30% of the population is dependent on for the benefits, whether education or medical benefits, then it becomes a huge challenge for the government to run the country basically. So that is why inflation, population increase does lead to inflation, but how you channelize this demographic dividend and how you control this inflationary overpressure, that is the major part. So even if you look at countries like US, Europe, which have gone through this peaking out cycle, it is not that inflation was sky high over there, right? Gradually, it just keeps on growing at a particular level. Because when we are talking about this explosion, it is not that the population growth will happen overnight, it happens over a gradual period of time. So Lucky Homes Goa in India, major percentage of population is between 30 to 45 age group, and most of them is jobless. And I personally feel that we are heading towards recessionary phase. Don't you think that after 15 to 20 years we are also in the same boat where US now? No, as I explained to you very clearly, if you look at US, we have peaked out in terms of the productive age, right? And in India, the major population is not 30 to 45 years. If you look at the demographic yield, basically most of the charts, I will share a link with you to help you with finding out these charts in various countries as to where we are setting and how the demographics will play out. So you can clearly see, if you go to this link, I've just posted a link below, Lucky. So you can go to this link, Wahid, right? So Wahid, you can go to this link and have a look that even in case of India, we will continue to in terms of the productive age group, we will continue to grow higher over the next 60, 70 years. So I don't think that's going to be a problem. Uh, Joblessness, yes, as I obviously told you, that demographic dividend is something we have had for a long time. How we channelize this demography into economy is a very important task that governments have to do. It is not that every time you go for you have a demographic dividend, it will certainly catapult you into a China like economy. There are many other things that have to culminate together to bring you to that level. So I think your point is right that if the jobless rates are not managed, then we can have problematic zones. But broadly, see, governance and governments can only do that much. The entrepreneurial spirit is high in a country like India, and when your productive group is so strong and is expected to be so strong over the next 50, 60 years, I am not doubting an inflation or not a recession in India in anytime soon, right? Probably, if globally something goes very bad, maybe we can have some problem. But other than that, I don't think much of an impact will happen. Uh, Bajaj Finance, again, I think how you view it, it depends on that. In terms of valuation, I think it's expensive in the current zone. and a lot of expectation is that the type of growth that has happened over the last 5 6 years, which was dependent, which was on a lot of factors, because Bajaj Finance morphed into something else, which it was not otherwise. So that helped them tackle this growth rate and everything. But going ahead, I don't think that Bajaj can catapult into further high growth rates because of this. So I think that is a problem that Bajaj will have. So I would wait for at least 1.5 year to look at whether they are being able to latch on onto that growth rate that they have registered over the last 3 4 years. So I think that will be a problem. I don't think they'll be able to do it, and valuations are not attractive per se. I would rather go into a smaller, maybe NBFC or BFSI company, which will grow at a decent rate over the next, say, 4 5 years, rather than buy a Bajaj Finance at 7 to 8 times price to book. Population increase, yes, population increase can lead to inflation, as I told you earlier. But again, this is not that the population increase happens overnight. It is very gradual in nature, and some bit of inflation is obviously good for any economy, because the ultimate nominal GDP growth is a sum of all this. So I don't think you have to read too much into this inflationary trouble out of population increase. I think the bigger challenge, as Wahid asked earlier, that the bigger challenge will be channelizing this population demographic dividend, basically, as we call it, into the productive labor force. And that's it. If we had to have no more questions, we can call it a day.